All right, everybody, good afternoon. My name is Doc Severson. You've got ReadySetTrade here, how to grow your money in the market. And today is Tuesday, the 23rd of March. So whether or not you're joining us through YouTube or if you're catching up on the 10X Tribe on our platform or watching at some point down the road in the future, welcome aboard. What we've got in store for you today is a pretty hot topic. We talk about this quite a bit in our trading room as well as just about everything that we do, which is the Zero DTE trades. So that is what we're going to cover today. Let's get into it here. And at the end of it, we will certainly take your questions. So today I'm going to go into just more of an overview on what the Zero DTE trades are. What are they and how do we trade them? So some of you may not know what Zero DTE trades are. So we'll get right into that first of all. So what are they? It's a Zero DTE means 0 days to expiration trade, uses options on equity options that expire today. Now, you guys might have seen this time decay graph before if you've traded options or had anything to do with something like that. You can also look at this as the value of anything that you've sold something, right? So maybe a coupon that, or let's say this is a baseball ticket for an event coming up. And maybe this is the opening pitch is right here. After that, it's not going to be worth much. Hey, Marcos, how you doing? So just everything in life has a certain time decay to it, where the opportunity is there, but then you can wait too long and something like that. Now, we're going to do the opposite to this. We're going to sell this to open. The analogy of selling this option is that we're holding an ice cube, walking ever closer to a roaring fire. And the closer that we get to the fire, the closer or the faster that the ice cube melts. Hey, Marianne. All right, so that makes sense, does it, right? You're walking across the room, you got an ice cube in your hands, and the closer that you get to the fire, the faster that it melts. So we have inherent edge walking or selling this wasting asset, and the trick is to keep it without giving it back. So this is kind of the insurance company model, right? We're selling something to begin with. Insurance companies do the same thing. They sell you a policy, and what they do in exchange for that is they take risk off of your hands, risk of your health, your auto, your house, whatever you want to insure. They take risk off your hands so that you can sleep at night. And so they get paid. You pay them a premium to take risk off your hands. And so we're going to do the same thing. That's like the insurance company model, but the policy that we're going to write is only for 1 day, only 1 day. Now, if we look at this, we could certainly do this on all, 8,000 stocks that are out there, or those that actually write options on them. But what we're going to find is that even in the best case for most stocks, they're only going to write options every Friday. And so unless we want to do this more than once a week, which we do, the better choice in this case is to go out to the S&P 500. So that's through the SPX, which is the larger cash index, or the SPY, which is the ETF of the S&P 500, which is 1/10 the size of the notional value as the SPX. So both of these will write options 3 times a week, Monday, Wednesday, Friday. And then on some weeks, we actually have Tuesday, Wednesday, Friday, or Tuesday, Wednesday, Thursday, Friday, depending on what's happening. Sometimes we'll have a holiday, like we have an Easter Friday coming up, and we're going to find that we have more than one option that week that we can sell, right? So Zero DTE trades are typically net option selling plays on the spiders or the SPX, available 3 times a week, where we sell to open a position for a net credit. So we receive the money to begin with, and then to close it, to eliminate our obligation, we're going to buy it back. And if we do this right, we'll have a profit on the trade. So there's other types of trades that we can be placed for a debit, like credit spreads, like time spreads, would be an example of that, where we start out with a debit and we hope to sell it for something bigger later on. But that's kind of beyond the scope of what we want to talk about today. So for those of you that are just joining us today, welcome aboard. Welcome to our 10X Tribe session today, where we show you how to make money in the markets. We're talking about zero DTE trades today. So just giving an overall primer on those, and I'll take your questions at the end of this. We'll maybe even look at the market and see what's happening today. I'm seeing red across the board now. And it's kind of strange because the interest rates are going down today. So a little bit of a conundrum, a little bit of a twist on things. So we talked about what they are. Now, when can we trade them? A couple of different answers to this, and maybe not necessarily what you would think. So these are, of course, Monday, Wednesday, Friday opportunities. What I will say is occasionally what we'll have is on the SPX, we will have this option which stops trading on Thursday. It's a Friday expiration, as you'll see the same dates here. So the next one that's happening is coming up in mid-April. It's a Friday expiration, but it stops trading on Thursday. The day before that, and of course, we don't want to go through the AM settlement process, so we can actually trade these once a month, those extra bonus options. There are some strange oddities around that. We don't have quite the same time decay of a normal zero DTE. So, but anyway, we have 3 times a week, right? So at least 3 times a week we can do this. Now, they're always closed prior to the closing bell. We do not hold these over expiration. We do not hold these and let them expire. We always, without exception, will close these prior to the bell. Weird stuff happens when you get into that after 4 o'clock time frame that you just don't know. A lot of times people will hold off on announcements and provide data a little bit later, and we can catch ourselves on the wrong side of that. So without exception, we will close these before the closing bell. Here's the example that was taken yesterday. We opened at 10:18 a.m. Eastern time and closed just about an hour later. That's pretty common, depending on what type of strategy that we're using. Now, this is point number 2, is like, when do we trade these? We want to trade these during a range day. A range day is where, and by the way, this is the opening range study that I have on Thinkorswim, and it shows what the opening range is for the first 30 minutes. So you can see in this case, we went above, went below, went above, went below, and then back into the range again. So this is a little bit more volatile than what I'd like to deal with, because this thing is all over the map. But ultimately, if you were to look on this, especially like on an hourly chart, this is a range day. This is a range day. Now, we'll have more to say about market character in a minute in terms of when we would expect to see range days more often and when we'd expect to see quieter range days. Now, this is a trend day. So actually, this is today's market action when I captured this a little bit ago, and this is yesterday's market action. And believe it or not, this is when we traded this, that earlier trade that we showed you. But this is a trend day. This is a trend day. It was almost like a one-way move here that we had. And it's, a trend day is where, you're going to see the S&P drop 50, 60, 70, 80 handles in one direction or another. And we don't want to be trading something non-directional during that time. Now, fortunately or unfortunately, we don't know when this is happening because we trade off the hard right edge. So at the time that we took this trade yesterday, we weren't aware that we were going to drop another 40 handles to the upside, or in this case, rise. Now, like I said, we can filter by market character when we are in corrective price action. So corrective price action is when we see stuff like this. This is corrective price action. This is actually, this whole mess in here is corrective price action, and this as well too, and maybe even this. These are where we have markets correcting. We have distribution in the market. Markets that move to the upside like this, you can just see they are much quieter. This is what we're looking for. This is the good stuff here. We're looking for the price to do these kind of things, because typically what we'll see on a day like this is we'll see a gap up pre-market, and then we'll see some type of range-bound behavior for at least the first couple of hours. And then who knows what happens into the end of the day. But we're trying to get in, get our fair share, and get out of the market before it decides to start moving again. And this was what we saw throughout the summer and into the fall of 2020 was we saw gaps up and then nothing. Gap up and then nothing. So much of the way through this type of stuff, with the exception of what we saw back here in June, and then again what we saw in September, October. But November on, all of this stuff was golden. Gap up, doesn't move. Now, when markets start to correct, when they start to really change character, and one of the things that I go over in the fractal energy program is that we're always going through periods of quiet and trending, transitions always to sideways and volatile. Quiet and trending always transitions to sideways and volatile, which we're sort of still in right now. We could be trying to migrate into quiet and trending and not, maybe not. We'll see. We'll see what happens in the next. If we're able to break out to the upside, we'll be back to quiet and trending. Otherwise, if this drops to the downside, then we're still in sideways and volatile. Almost at a tipping point right now. But for those of you looking for high probability trades, what you want to do is you want to filter by market character. You want to look for these times where the market's just sort of quietly grinding higher like this, where the market's quietly grinding higher. These are going to provide you much better opportunities for that. You want to avoid when you start to see the market distribute, all of a sudden you're going to see volatility kick in, you're going to see the VIX kick up, and this is the time to step back from this type of strategy. And it hurts me because I see people in all kinds of forums online or Facebook groups, and they get into this corrective market action and they beat their head against the wall for weeks at a time going, man, I'm really terrible at this strategy. No, you're not terrible at it. What you're trying to do is you're trying to bang a square peg into a round hole. That's what you're trying to do. You're trying to trade a non-directional strategy during a very directional type of market character. So understanding the bigger picture of what's going on in the market will pay dividends for you, at least indirectly, maybe not real stock dividends. So now we get into the third question, which is how do we trade them? This is what everybody wants to know, even though what I've just talked about is maybe the most important point. First of all, we want to be a net seller of options. We're selling a wasting asset that is going to expire that day. So that's a huge edge. That is a huge edge. We can do this through credit spreads or we can use debit spreads, either of them. You can be a net seller of the options if you want to be, depending on how you structure this. The most popular approach is a short gamma trade, where we're looking for the absence of movement, something like an iron condor. I would say if you ask 100 traders that do zero DTE, I would say probably 95 of them are going to be operating with some variant of iron condor, where we're looking for the price to stay within this range in here. Now here's something that's a little bit different. We can choose to be a random walk trader. If you guys know what random walk is, this is Mr. Burton Malkiel, and wrote A Random Walk Down Wall Street. What he believes that technical analysis is for the birds and that charts belong at the bottom of the ocean along with the other sunken galleys out there. Does not believe in any kind of power of technical analysis. And then, of course, if you have the other side of the coin, which people get very religious about, and they say, yeah, but what about with this? And what about the bounces off the moving average? And what about support and resistance and everything like that? So I'm not here to argue for one side or the other. I think both of them have their own merits, and we use both of these religions in what we do here. But I think what you have to do is you have to decide what type of trader that you are going to be. Are you a random walk trader, or are you a technical discretionary trader? So you have to make a choice before you start whether you consider price movement to be the main risk or time movement to be the main risk. Think about that for a second. And most people don't think about that because, like, a lot of folks will set up their trades really, really wide like this. They'll set up some super wide iron condors. And it gives you an enormous amount of range. And you sit there and say, man, this is a great trade. This is safe. Well, why is it safe? Well, it's safe because my wings are super wide on this iron condor. Okay? The problem with a trade like that is you've got to sit there all day long. It's like you're sitting on an egg waiting for it to hatch, and you have to sit on that thing all day long because options that are out of the money like that do not decay very quickly. And you didn't collect very much credit to begin with, so if you want to shut it down early, you're going to be giving up a tremendous amount, a big chunk of your credit. Now, we can compare that versus something like this. We can set up the trade like this with much smaller range. In fact, we can actually collapse the range to next to nothing. And this is the profitable range at expiration for this trade. Much smaller. And so you might look at that and say, well, that's a stupid trade. Who on earth would do something like that? It depends on whether you determine that price risk is your biggest enemy or is it time risk. And I would say in today's market, it's almost time risk of sitting in a trade all day long. And again, I read a lot of forums and comments from people that are trading out there, and man, to hear somebody sitting on a trade all day long and like, I was profitable until the last 15 minutes of the day and I got stopped out. You know, you can just hear them screaming in pain on something like that. What did we do yesterday? We got in, got our fair share, we got out. We used a trade like this. So I would say to you guys that most people are going to start thinking that a trade like this with the great big wide wings, and that's why they call them condors to begin with, because they're great big birds with wide wings. You're going to come into this with the notion that widening out the trade even further is the safest way. And I'm going to challenge that assumption and say maybe the safest way is to get right in close. So think about this. I love analogies, but if you're fighting a battle, would you say that you're safer on the front lines, or would you be safer way in the rear, 5 miles behind the lines, like in an artillery unit? So you're sitting back here in an artillery unit, just, flinging shells 5 miles away, and you think, wow, this is great. There's nobody shooting at me. And you're in relative safety. Well, that works really well until the enemy decides to flank around the main forces, and all of a sudden you're unprotected. You have no infantry around you. There's nothing that you can do. And you're going to get slaughtered. And the other way to look at this is in the front lines, at least you've got all of your buddies there, right? You are protected. You are protected. So there's different ways to look at this, and I would challenge how you approach the market to begin with, right? So your approach is also dependent on your desired availability for the day. Not everybody can sit around and manage a trade all day. I choose not to sit around and manage a trade all day if I can help it. I've got other things to do, and I think it's very unproductive to sit there and stare at a screen all day. A lot of people want me to sit there and stay online all day long and pump trades out. And I think it's probably the worst possible thing that I can do for people is to stay online. We prefer to focus our activities, or at least I prefer, and I'm trying to encourage you guys to focus your activities to a very small period of time. Doesn't matter where it is during the day. Could be at the beginning of the day. It helps with these types of trades because you're right there at the very beginning. But either way, finding one window where you can focus with 100% on what you're trying to do in a very small period of time, I think makes you much more effective. Trust me, I've done that. The whole thing is staring at a screen all day long, and at the end of the day, you feel like you've gone through a battle, and you're not very sharp by the end of the day. By the end of the day, you're just, you may have dug yourself a hole, and you're just trying to dig yourself out of it, and you're reaching for anything that walks or crawls, that even resembles a trade setup, instead of being patient for it. So let's talk about discretionary skills for a minute. If you choose to go discretionary, instead of a random walk, you're going to go technical on your setups. Man, everybody's so quiet today. It is a fool's errand. I don't want to insult anybody here, but I will say that it's a fool's errand to think that you can predict future price action. You cannot. You cannot predict future price action. A lot of people send me emails and say, hey, Doc, what do you do to predict future price action? Nothing. It's not the point of technical analysis. The point of technical analysis is to look for certain clues to whether the price is breaking out. I'm more reactionary. I'll set up a range and say, okay, so I think the price is, if we see the price breaking out above here, here's my action. If we see the price breaking down below here, that's my action. Could go either way. Where most people make the mistake is they think that they can predict the future, so therefore they align themselves with one direction, one outcome only. And what happens with the subconscious mind is it directs your reticular activating system to go out and find corroborating information that aligns with that specific belief or bias. And this is why it feels like such a violation. It's such an attack to your soul when the price does the opposite thing than what you expected. And it may have started because you listen to some dude on the air or some YouTube video or somebody on CNBC or something like that, can, with great conviction and confidence, predict what was going to happen. And you go, I like that. I like that, what that person just said. And that is the beginning of confirmation bias. This is where it's almost like taking a drug, right? All of a sudden, you're just going to narrow your point of view to whatever that person believes, and you're aligned with that, and you do not see the other side. The problem, therefore, is you focus on what you fear, and you can't see the opportunity around you. You can't see what else is going on around you. You're going to focus on only the stuff that scares you. And for those of you that ride motorcycles, this is called target fixation. It can be fatal. You fixate on what you're scared of, and you end up riding right into it. And this is what happens to us as traders as well, too. So this is a long-winded way of saying what you can do is to look for specific clues as to whether the day leans towards being a trend day or a range day. Which one do we want? We want a range day. Are we able to predict that? No. But there's certain clues, there's certain things that we can do to be able to avoid the bad days and encourage activity towards what we think are the good days or a range day. Are we able to predict that? No, not with 100% certainty. But there's, any clue or any skill that we can use to identify the difference between a trend day and a range day is what we will do. So no indicators. A lot of people will say, hey, well, what studies do you use intraday? None of them. They're trailing. So a typical study like a MACD or a stochastic or an RSI or whatever you want to throw out there are trailing. They will not work for what you need. They will not give you an edge intraday. So we use price-only reads. Things like gaps. What's the gap? Is the price going after the gap? Does it not care about the gap? Is it going to be a gap and go or a gap and crap day? Where's the opening range? Is the price staying within the opening range after it sets it up? Or is it trending above or below the opening range, indicating a potential trend? What's the expected move of the day? What are the options pricing in? There's a lot of structure that we can provide. And we do this every Monday, Wednesday, Friday morning. We come into the day and we say, all right, what's our expected move? What's our opening range? What's going on here? What's the price doing? What's it showing to us? And we use these clues. So I kind of have a hybrid approach. I say, look, I can't predict the future, but I'm going to look at these things in front of me. I'm going to look at these things in front of me and make a decision based on them. Or we can just be a random walk trader and enter at the opening bell. So there's a certain amount of edge that happens when you enter at the opening bell. This is when your maximum premium is going to be. However, you are a hostage as to what could happen in the opening range. A lot of times we'll sit there and open up at the opening range and then thing takes off. And you're about to be stopped out. And you have to be able to be okay with that because you're trading one edge for another. So you've got to pick what works for you, what makes sense to you, what you will commit is extremely important, what you'll commit to. Remember, guys, we're not trading against the market. We're trading against ourselves. You got to understand that. You're really not trading against the market. The market's out there every single day trying to tell you what it's doing. It's trying to tell you which way it's trending. It's trying to tell you what character it is, what kind of volatility is out there. It's trying to tell you what edge works with this specific market. But we tune it out because we have confirmation bias. We know better than that. If we just listen to the market, let it tell us what it wants and just give it to it. It's a really simple business, but we make it difficult on ourselves. So some common strategy applications here is way out of the money iron condors. And these are where we have short strikes at maybe 5 to 10 delta. So you'll hear about people doing these. And these are way out of the money. Now, what you're looking at with a trade like this is you're looking at a relatively poor reward to risk. That's the zero line. So you may be looking at something like 9 to 1 risk to reward. But the probability is super huge, right? The probability is enormous on a trade like this. But there are going to be those times we're going to have those 2 and 3 sigma days where you just get run over. Even though you started out with a super wide trade. Anything can happen. You have to understand that. So those are the super wide iron condors. We talked about that. Some people view them as being safer. I don't believe there is such a thing as safer. You have to determine what makes sense to you. Now, there's also the expected move iron condors. A lot of people do expected move iron condors. They are pretty much looking like this. So they're not super far out of the money. They're the 15 delta. So these are, there's a 15% probability of the price of that short option being in the money by expiration of that day. So they're not as wide. So both of these are 15. They're not as wide, but they give you a 68.2% chance of probability. And a lot of people will say, that's better than 50-50. I love it. Just understand that you're looking at maybe risking 2 to make 1. And then we have the low probability iron condors. And these look like this, and they are actually a 50%. You're risking 1 to make 1 on these. Now think about this for a second. As you go further down this continuum, what's happening? What's happening? You're improving your reward to risk, yes. But what else is happening? The speed is going up. These ones take all day. These will take the entire day to get your target. Sometimes better than that, but most of the time you can figure on spending all day with that. When you trade an expected move iron condor, For us to hit our target in the room, we were finding this was about maybe 3 hours. When we traded the low probability iron condor, we were hitting our target about 90 minutes, maybe as much as 100. I'm trying to write with a mouse here, so cut me some slack. And then there's a fourth one, which is the iron butterfly. The iron butterfly looks like this. We actually mashed together the short strikes at the same place. We mashed the short strike, so we have one common short strike, and then we just determine the width of the wings here. We determine the width of the wings from the center point. And these can be anywhere from 10 minutes to maybe as much as 60. So which of these, I ask you, is the riskiest? None of them, right? It depends on what you find to be risk. How do you define risk? Is it sitting there with a target on your forehead all day long? I don't want that anymore. I used to trade like that when I first got into the business. I was the king of these super wide iron condors, and when the market would move, I would not sleep at night, and I hated that. And I had to find a way to change things because, yeah, you win the majority of the time, but you're constantly miserable because no matter what happens, the price moves one way or the other. And it was difficult, right? So what I found over time was narrowing things down, reduce my time risk, and allowed me to be more productive during the day. So I'm not saying one's better than the other. I'm just saying, think about the other side, which you may not have considered. So what I'm going to do here is through the rest of this, no more soapbox preaching. I'm just going to run to the analyzer here and talk to you about different types of strategies. Okay, different types of strategies. So what I'm going to do is just go to my analyzer. This is Thinkorswim, by the way. And we are going to go to the analyzer and go to the SPX. So here's the SPX. And we do have one trade in there, and I'm not going to show this one. We're going to go to, if we can make this work here. There we go. We're going to hide our positions, and we're going to start from a blank slate. Hey, Willis. Any questions before I start to get into this? And we'll open it up for any questions in a minute. But if you have any questions about what I'm doing here, let me know. Okay, so now we don't have 0-day options right now. If I go to add simulated trades, I don't have a 0-day option, but I can do the next closest thing I can do, a 1-day option. Hey, Luigi. So let's look at this. Again, let's set up a trade for tomorrow with 5 delta options. And we'll trade these five points wide. So I'm going to analyze selling an iron condor. We're going to sell the 38.10 put and buy the 38.05. That is creating a credit spread down there. And what I need to do is to move up to here as well too and create the associated call credit spread. And we're going to pick the 6 delta option up there at 39.65. And we're going to make the long option 1 strike further out of the money at 39.70. Okay, so there we go. Guess what? Per contract, we make $30 per contract, 30 bucks. Let's look at our risk profile. There it is. So what are we looking at here? We're going to make $30 of credit. And we're going to risk 470. whether or not the price goes up or whether the price goes down. As long as the price stays within this range, which is from 38.10 up to 39.65. Now understand that tomorrow morning the numbers will be different. They'll be a little bit more narrow than this. But a lot of people will look at, a lot of beginners to options will look at this and say, well, my God, that's 155 points on the S&P. How could you possibly ever lose that trade? Look how wide that is. Look at the probability of success on that trade. Wonderful. Don't forget that you're only making 30 bucks and you're risking 470 per contract on that. Now, start to scale that up and you'll say, well, wait a minute, I want to do more than one contract. That's just too small. Let's go to 10 contracts for this. Okay, that's more worthwhile. You're looking at making $300 for the trade if you let it expire, but you're also looking at losing $4,700. Imagine that. One loser out of 10 eats up everything and more out of those 9 winners. So to do a trade like this, you have to use active stops. You have to use active stops where you will blow out of the trade or manage it. I'm not going to talk about those methods right now. That's way beyond the scope of today. But you can see that you just cannot let that happen. The numbers will catch up to you sooner or later with a trade like this. Okay, so let's kill this one. Let's go to the next one. And now we're going to do an expected move iron condor for tomorrow. Whoa, we're getting some distribution coming into the market today. So we are down, let's see, almost 1%. The NASDAQ is actually holding up pretty well, but it looks like banks are, let's look really quick here and let's see what's getting hit. Industrials, banks, energy, communications, builders, just about everything. The only thing that's hanging in there is utilities, and that tells me that the 10-year note is actually down today. So go figure. We thought we gave the market everything it needed, and it's still not happy. Could be an interesting day tomorrow, all right, depending on what happens. Don't forget, we have Fed speak going on, and I think we had some, did we not have Jerome Powell on today at noon? He must not have lit up the market. All right, so let's go back to, let me stay on target, stay on target, stay on target. We're going to add an expected move iron condor. So what we're going to do is we're going to go out to about a 15 delta here and set up an iron condor, and we're going to make these 5 points wide. So we have our about roughly 15 delta to the downside, and now we need to do the same thing to the upside. We're going to go 39.45 for the call. 39.45, and then the long call is going to be 39.50. And that's going to give us about a little bit different risk profile here. Okay, so you might look at this and say, wow, that's super narrow, but yeah, it does a better job. So let's look at what we have here. We're only risking, in this case, we're looking to make about 120. So we got significantly more credit, and our risk down here is going to be 380. So we're risking a whole lot, well, not a whole lot less, but we're risking quite a bit less, and we're looking to make 4 times as much, which is good. That's more gooder. So 380 up and down. Okay, so what's the negative of this? The negative is you have less range to work with. Well, what's the positive to this? The positive is this trade works much faster. This time decay will work much faster for this trade than the super wide iron condors. So again, this trade is about 3 hours maybe to pull off maybe about 50% of the profit of this. About 3 hours. If you want 100%, you're going to have to stay in there all day long. That's typically not how we do this. With the high probability trade, though, the super wide ones, you'd have to stay in all day, because even closing down those trades, think about that. If you start with a $30 credit, if you have any commission cost at all, you're tearing down both sides. You're going to have fees and expenses on that, and it eats into those profits. You may only end up with 15 by the time you're done with it, even with today's low commission rates. So this is one way to fight back, is actually to go sooner or closer. That's the expected move. Let's keep on going. Let's wipe this one out. Let's go to a low probability iron condor. These are all trades that we can do in the space of one day. The the low probability condor, we're going to go for about a 30 delta. About a 30 delta is about where we want to find these things. Okay, so 85, 80, we're coming much closer to the money. These are tomorrow's options. These are not today's. These are tomorrow's options, so they're going to be a little wider. And then we're going to move up our call spreads to 39.25 for the short option and 39.30 for the long option. These are all $5 wide spreads. Okay, so what do we get now? We've gotten more narrow. That's the downside. What's the upside? What's the upside here? On this specific trade, we pulled in 265 of credit. What's our risk in this trade? 235. Okay, that sounds better, right? 265 is better than 110 or 120, and it's better than 30. And the risk is lower. What's the downside? The downside is you have less range to work with. What's the upside? Reward to risk is better, and the time in the trade is better. This is about a 90-minute trade. 90 to 100 minutes or so to grab about 50% of the profit available in this trade. Let's go one step further. That's the low probability trade. Let's go even lower. We're going to go right at the money. We're going to play close quarters battle, right? We're just going to go, this is house to house, hand fighting. Price is about 39.06. We're going to go right at 39.05. We're going to analyze selling iron condor, and we're going to go with about a 35 wide. We're going to set these for 39.05, and I'm going to add 35 points to this for the upper call, so that's going to be 39.40, and I'm going to subtract 35 points for the long put, which is going to be 38.70. Now look at that. Okay, what's our credit? $22.45 per contract. Whoa! Compare that versus 30 bucks. What's our risk on the trade? $12.55. Now, what's good and what's bad about this? What's good is we're looking at a much bigger credit. What's bad is we have a lot less room. Also, what's bad is look at the risk on this trade. Whoa, that's a lot of risk. Now, understand that that's a very flat P&L curve. It's a very flat. You don't get into this until the expiration. What's the biggest advantage to a trade like this? Time decay at the money happens very quickly. This is a 30 to 60 minute trade. 30 to 60 minutes. So you have less room. Remember, everything in options is a compromise, right? You can never be happy with everything that you get. If you have less room, you're going to get more credit. More credit, you have less room. So this is roughly a 60-minute trade or less. Sometimes we've done them in 10 minutes. In, get our fair share, get out. That's what makes sense to me. This is the way I like to trade. Other people go with the big wide wings, right? So let me wrap things up. That's our Zero DTE. We've talked about what Zero DTE is, what a 0 days to expiration trade is. We've talked about the fact that we're typically selling these to begin with. Now I could set these up with a calendar spread. I could do something like this. Let's blow this one out and set up a calendar spread. We can do this selling this one. We can do like a 38.05. We're going to analyze buying this one now, a calendar spread, and we're going to go out about a week. So we're going to sell the 24 March, and we're going to go out to maybe like a 5 April, something like that. Now that's not a cheap trade. It's $2,900, but let's see what we have in terms of risk profile. Kind of the same thing as the iron butterfly, right? Kind of the same thing. It has similar characteristics, but it requires a lot more qualification and it requires a lot more management of a trade like this, because all of a sudden you've got things moving in more than a couple of different dimensions and much more sensitive to changes in volatility. So point being is that you can set this up with a debit if you want to, if you're more comfortable with that. Any questions? That is the Zero DTE trade. This is something that we look at every Monday, Wednesday, Friday. We don't trade them every single day. We don't trade them every single Monday, Wednesday, Friday. Sometimes we have nice, good, clean entries. Sometimes, like yesterday, I said, I'm not going to publish this trade. This is trade for advanced traders only. Which to me makes sense. All right, any other questions, or do you guys want to look at the markets or anything like that? Let's look at the charts and let's see what's happening. Nothing happening with Kroger. Let's go out to the S&P. And the S&P just continues to not go anywhere. And this is odd because we have a tremendous amount of energy and it should be able to break at this point. And the fact that it's not is interesting. Now, something else that I'm looking at here, I'm just going to go out to just a single price chart, is to look at the Qs for a second here. The Qs, of course, are the NASDAQ 100. And what I talked about yesterday, I wrote this into the room, is that we have a potential inverted head and shoulders setting up here. Now, if we get the volume and the squeeze, we could see this break to the upside. However, what I also qualified it yesterday in saying is that this could go both ways. This might be just, here's a break to the upside, a failure with a lower high. So our decision point is we're long if this breaks above the neckline here. If it breaks above the neckline, more than likely this thing is going to take off, especially if it's accompanied by good volume. If, on the other hand, if this sets up as a lower high that dies from here, that means that the bulls were not able to grab control. They were not able to create the short squeeze on the right shoulder of the inverted head and shoulders pattern. And we're going to see a very quick, very nasty retest of the 200-day moving average. And that's if the Qs drop through 310. More than likely, it's going to happen. Also, watch for gaps. Watch for gaps that happen pre-market where we gap through a level. If we gap through a level, like gapping through a level like this, that's a gap and go, or we have a gap and go to the downside. Watch out for these because this is a professional gap. This is institutions getting a jump on what they see going on. Leaving retail on the side, that's what they love to do. So that's what I'm seeing on the Qs. Again, if we go out to the intraday chart, we can see that this has turned into a trend day. We started out with a range day and it's turned into a trend day. It's always the last 90 minutes that counts. It's never the first hour or 2 hours or anything like that that matters in the market. It's always the last 90 minutes that matter the most. Amateurs open the market, the pros close the market. So today's drop is not necessarily a good thing right now. There must be uncertainty out there. I haven't clued into what Powell said today. Remember, this has been Fed speak week, man. There is more Fed speak going on. They must be nervous about something. What's that line from Shakespeare? Methinks he protesteth too much. When you got too many Fed speakers out there trying to push a narrative, you got to wonder what's going on. Okay, anybody else have anything? Any other questions? Anything else? Nothing heard. Going once. Going twice. All right, thanks everybody. Thanks for hanging out with me here today at ReadySetTrade. We talked about the Zero DTE. If you have any questions, let me know. And if you're not a member of the 10X tribe, please go ahead and join us at elite.readyset.trade. It's free. Join us at the 10X tribe. Be part of a community. All right, everybody. Thanks very much. You guys take care.